Hi, this is Jared Rogers from Beyond Accountancy. Welcome back to our YouTube channel. The federal budget happened last night. It's usually a major milestone in the year for accountants and other advisors. So what happened and what can you do about it? Now, there's plenty of people who are going to summarize the politics and the economics and those sorts of things. I'm not going to touch any of that. I'm going to focus on what tax strategies are going to be helpful to you from the point of view of your personal finance, or if you're a business owner, or if you have a superannuation account and you're a retiree. But what happened yesterday? Lots of the usual political announcements. Nothing much new or helpful for SME, that's small or medium enterprises, so businesses, or superannuation or individual taxpayers. However, there are some other recent changes that could provide some opportunities for you. So first, some general things. Energy bill handouts, that was a big one in terms of their focus. So $300 for households, $325 for eligible small businesses. However, it excludes home offices and excludes if you're a subtenant or in a serviced office, which is a lot of the businesses that we help who are in the professional space. So you need to have your own separate meter in the name of your business that you're paying. Stage 3 tax cuts, and they announced them ages ago. They were emphasised in the budget speech last night, but they'd already happened. So these are the amounts from the government website. How much will you save? Well, not a lot, but there's a calculator you can use on that. I won't spend any more time on it because you can't do much about those changes. They've just happened. So let's talk about strategy. I'm going to split it into two parts to keep the video length shorter. This part's going to be about retirees and those retiring soon. And the second part will be on business and personal income tax. So what happened for our retirees? Well, firstly, what didn't happen? So there was no clarity on the new tax on super balances over $3 million. There are lots of issues with that. The superannuation professionals have been asking the government to clarify and to remove some of the unintended consequences. Nothing's been done. There's been very little response from the government, full stop, and none last night or 2 nights ago now. I thought there might be some risk that they would bring the superannuation age down from 75 back to where it was at 67, but it wasn't changed. So those of you who are in that 67 to 74 bracket still have the opportunity to use super. They've frozen the price of medication for concession card holders. Centrelink deeming rates have also been frozen. And a recent change, this was last year, the limit for a Commonwealth Seniors Health Card increased substantially last year. So in this lawyer-riddled world, before we go into strategy, I need to say this is not advice, it's just information. You're welcome to book a tax advice appointment. If you want financial advice, you need to consult a financial planner. So strategy 1, do I have too much in super? So if we combine the stage 3 tax cuts plus the problems with the new 30% tax on high super balances, plus the existing tax rates on super, that could mean you might be better off reducing your super balance. So pre-2017, you could have as much in super as you like, and it wasn't an issue. It didn't cost you anything, but now it does. And it's all about tax rates. So with the stage 3 tax cuts on the left there, income up to $45,000 only gets taxed at 18%. Think about superannuation balances. The earnings on your super, if you've got more than 1.9 million, you're paying 15%. So at the very least, you want to move or think about, are you better off moving assets out of the superannuation system and using up your tax-free threshold? And even potentially using up the tax-free threshold and the next bracket. Because yes, 18% is more than 15%, but only by a marginal amount. And you're out of the superannuation system, which is subject to so many changes and a not insignificant amount of corruption. And what about if you've got assets over $3 million and you're going to be paying this 30% tax as of July 2025? Well, it would make sense if you're not using up your first two tax brackets to move some assets out of super, because the tax rate is going to be significantly lower. Just makes a lot of sense. And again, even moving some money out of super into your own name, because even though you're paying 2% more tax, that's not much of a difference. And also, in your own name, you're paying tax on actual profits. One of the big problems with the new super tax is that you're paying tax on unrealized profits with unclear and unfair rules. So fast forward 12 months from now, I think you're going to see a lot of people with high super balances restructuring their affairs, moving money into a spouse's name, or taking money out of the superannuation system altogether. Strategy 2 could be to apply for a Commonwealth Seniors Health Card. So again, last night we had a freeze on PBS medication prices. You need a card to get those cheaper prices. We've got a freeze on Centrelink deeming rates. I'll explain what that means. And a change to the limit to get the card. And those three changes combined suggest that you should be applying for one of these cards. The change to the limit was actually last year. So the income test for one of these cards is your taxable income plus a deemed amount from your super accounts. Last year we had a significant increase to the income test. You can now earn $95,000 as a single or $152,000 as a retiree couple and still get this card. It's for those who are pension age but have too many assets for the age pension. There is no assets test for this card. That screenshot is straight from the Centrelink website. And last night we had an announcement that the deeming rate would be kept low. So it's 2.25% of your superannuation balance is counted as income when you're applying for this card. So let's put an example to this. Say a retired couple, they've got $1 million of investments in their own name, which earn $50,000 a year for them. They've also got $1 million each in superannuation. They're going to have $50,000 of taxable income, $45,000 of deemed super income because of that rate being so low at 2.25%, and a total income of $95,000, which seems significant, but they're well under the limit and therefore entitled to that card and to the benefits that come with it. And it's not just the cheap PBS medications, there are other benefits as well. And our last strategy for our retirees is that it's not too late to add to super. As I said, I thought there might be some tightening of the age limits. They might bring those down back to a lower amount to stop people using super and therefore saving tax, but that didn't happen. So here are the superannuation limits as of today. The annual amount that you can put in as a non-concessional or after-tax amount is 110 grand. You can use the bring forward rules. That's where you take 3 years and bring them into one, and you can put in 330,000. So I can put 330,000 in my super today, and that counts for 2024, 25, and 26 financial year. So you might conclude the most I can add to super in one hit is $330,000. But that's wrong for two reasons. Firstly, the superannuation cap is increasing. So it's going from 27,500 to 30 for the concessional limit, and the non-concessional is 4 times that. So it's going to go to 120,000 or 360 if you use the bring forward concessions. So if you had a lump sum to invest, or you realize you were paying too much tax on your personal investments and wanted to hold them in super, yes, you can put 330,000 in this financial year, or you could wait until July and put in 360,000 so you get a little bit more in. Or if you were clever with your timing, you would put up to 110,000 in this financial year, and then the 3 years would reset. And so you could put another 360 in July. So if you get your timing right, you can have $470,000 added to your super in just the next 2 months. You might say, well, I don't have any funds to add to super. I've only got about 400,000 full stop. Okay, that's fine, but consider a recontribution strategy to prevent future tax. So future tax being the government changes the rules, or future tax could mean there's a death tax on super of 17% if you leave it to your kids, and a recontribution can help reduce or even eliminate that tax. And don't forget that this is subject to age. You've got to be under 75, and your total superannuation balance has got to be under 1.9 million. If you want to hear more about any of these strategies, perhaps more of an explanation of a recontribution, why it's useful, put a comment on the video and I'll think about doing some more detailed videos on specific topics. But that's it for part 1 of our budget night update. If you enjoyed this video, please like and subscribe. Please put comments with suggested videos. That would be helpful for me to know what's going to be useful to prepare for you. If you want some help putting these things into action, we can help with tax advice. We've also got financial planning firms that we collaborate with to make sure you're getting the best tax and financial outcome. Thanks for watching, and hope you can join me for part 2.